Analysis of financial institutions. So the focus of this reading is on financial institutions. We'll start out by talking about the different types of financial institutions. We have banks, we have insurance companies, and then we have investment companies. The focus of this reading is going to be on banks and insurance companies. We'll also talk about why financial institutions are different from other types of companies. We'll discuss how to analyze a bank using the CAMELS approach. Here, C stands for capital adequacy, A is for asset quality, M for management quality, E for earnings, L for liquidity, and S for sensitivity to market risk. So we'll use the CAMELS framework to analyze a bank, and then we will look at how to analyze a bank using non-CAMEL factors. From banks, we will move on to insurance companies. With insurance companies, there are two broad categories. We can have property and casualty insurance companies, and then we have life and health insurance companies. So we'll talk about how to analyze these two different categories. So let's look at what makes financial institutions different from other companies. One major difference is that financial institutions have a very high level of systemic importance. This is because there is a high level of systemic risk associated with financial institutions. So let's understand why this is so. Consider a core part of the financial sector, which is banks. So let's say we have the banking system over here. And in this banking system, we have several banks. So we have Bank A, Bank B, Bank C, and so on. So each of these are individual banks. Now, all sorts of entities interact with the banking system. We have households. So households put their savings into the banking system. When households need to borrow money, they borrow money from the banking system. We have companies. So companies borrow from the banking system. If they have extra money, they save using the banking system. We have the government. So the government generally borrows from the banking system. In some cases, the government might also save. And then the banking system also interacts with other financial institutions. So notice the banking system is at the heart of the economy. Now, another important point is that the entities within the banking system also interact with each other. So Bank A might have a relationship with Bank B. So Bank A might have a borrowing position or a lending position. Bank B, in turn, will have positions with Bank C and so on. So there is a lot of interbank borrowing and lending that takes place. Now, to illustrate the systemic importance, let's say that because of some reason, Bank A is in trouble. If Bank A is in trouble, that means that the households and the companies that are dealing with Bank A have a problem. Also, let's say that Bank B has lent money to Bank A and needs to get that money back. But if Bank A is in trouble, then Bank B will not get its money back, which means that all the entities that are interacting with Bank B also have an issue. So through this simple scenario, you can hopefully get a sense for the systemic importance of the banking sector. And as mentioned earlier, high systemic importance means that there is high systemic risk. So what is the definition of systemic risk? This excerpt has been taken from the curriculum. Systemic risk is the risk of disruption to financial services that is caused by an impairment of all or parts of the financial system and has the potential to have serious negative consequences for the economy as a whole. So if we have a major impairment of the assets associated with Bank A, notice based on the scenario that I just described that issues with Bank A can have an impact on the whole banking system and then on the economy. Another important term in this context is financial contagion. This is a situation in which financial shocks spread from their place or sector of origin to other locales or sectors. Now, there are several examples of this. In 2008, we had a financial crisis that started in the US and then that spread to other parts of the world. When this financial crisis started, it was focused on the mortgage-backed sector of the securities market in the US, but then this crisis spread to other sectors of the economy. We now come to the second point, which is the need for regulation. Given the high level of systemic risk, it is very important that the financial sector is well regulated so we have financial stability. And later in this reading, we will talk about the types of regulations that exist in the financial sector. The third point is that liabilities are made up primarily of deposits. So if we consider the banking sector again, most of the liabilities are deposits. So when households or companies put their money in a bank, those are basically deposits. The deposits represent a liability for the banks, and the depositor has the right to withdraw money at any point in time. So that also leads to risk, because if the bank does not have enough money and the depositors want to start withdrawing their money, that can lead to a crisis. And this has happened in the past. If there is a perception that a bank is in trouble, then depositors will line up in order to withdraw their money, and that situation is called a bank run. So the key point is that liabilities are made up primarily of deposits, and one example given in the curriculum is that in 2016, in US-based commercial banks, deposits represented 80% of the liabilities of these US banks. The fourth point is that assets are predominantly financial assets. Now, again, going back to banks, with all the money that banks get, basically that money is invested in financial assets. So a major chunk tends to be loans. Banks issue loans, so those loans are assets as far as the bank is concerned. Some money is invested in financial instruments such as stocks and bonds. So again, those are financial assets. And then banks might also invest in highly liquid securities such as government T-bills. So notice all these assets are financial assets. Since the assets are primarily financial assets, they are subject to various risks such as credit risk, market risk, and liquidity risk. On this slide, we look at a sampling of financial institutions. So we have three broad categories. The first category is institutions that provide basic banking services. Then we have intermediaries within the investment industry. And the third category is insurers. Within the first category, which is broadly referred to as banks, we have commercial banks, credit unions, cooperative and mutual banks, and then we have specialized financial sector providers. In the second category, which is intermediaries within the investment industry, we have mutual funds and exchange-traded funds, we have hedge funds, we have brokers and dealers. And then in the third category, which is insurers, we have property and casualty insurance companies, life and health insurers, and reinsurance companies. This reading focuses primarily on the first group and the third group. And as I said before, the first group is broadly referred to as banks. The third group is called insurers. And in this reading, within insurers, we focus on the first two subcategories, which are property and casualty and life and health. There are several global organizations working in the area of financial stability. The objectives of these global organizations, as well as regional regulatory bodies, is to minimize systematic risk. These organizations also harmonize and globalize regulatory rules, standards, and oversights. They try to ensure consistency of standards and regulations in order to minimize regulatory arbitrage. The concept of regulatory arbitrage is covered in detail in another reading, but in very simple terms, if we have two jurisdictions where the regulations are different, then companies will prefer jurisdictions with less regulation. By ensuring consistency of standards and regulations across different jurisdictions, global organizations try to minimize regulatory arbitrage. One of the most important global organizations focused on financial stability is the Basel Committee on Banking Supervision. The Basel Committee has members from central banks all over the world as well as several regulators. Their key output is the international regulatory framework for banks called Basel III. Several years ago, this committee issued a framework called Basel I that then evolved into Basel II, and the current framework is Basel III. Besides the Basel Committee, other organizations involved in financial stability include the Financial Stability Board, the International Association of Deposit Insurers, the International Association of Insurance Supervisors, and the International Organization of Securities Commissions. Now, you just need to be aware of these organizations. Our focus is going to be on the Basel Committee and the Basel III framework. So let's dive into the Basel III framework in a little more detail. The objectives of the Basel III framework are to improve the banking sector's ability to absorb shocks arising from financial and economic stress. Now, these shocks might be from any source. The objective of the framework is to absorb these shocks and minimize the impact. The second major objective is to improve risk management and governance of banks. And the third objective is to strengthen banks' transparency and disclosures. You need to learn these three objectives. You also need to know the three major highlights of the Basel III framework. The first has to do with minimum capital requirement. Now, the idea here is straightforward. Banks have assets, and on the liability and equity side, there will be liabilities and then there will be some equity capital. If there is some sort of a financial shock or economic stress, then the value of assets will come down, the liabilities will stay the same. To absorb the loss in value of assets, we need equity capital. The higher the amount of equity capital, the safer our banking institution will be. What the Basel III framework does is it establishes guidelines for the minimum amount of equity capital that is required. This is something we'll discuss in more detail later because not all assets are the same. Some assets are riskier than others, and also within capital, there are several different tiers that we need to be aware of. But the basic idea is that the framework tries to ensure at least a minimum amount of capital. The second point has to do with minimum liquidity. According to the Basel III framework, banks should have enough high-quality liquid assets to cover their liquidity need in a 30-day liquidity stress scenario. So what does this liquidity stress scenario mean? There might be a situation where funding sources dry up. So, for example, customer deposits might not be coming in, or it might become difficult to borrow money from other banks. A liquidity stress might also be created if there is a large outflow of cash. By maintaining a sufficient amount of high-quality liquid assets, banks can manage their liquidity risk. The third highlight has to do with stable funding. Basel III requires banks to have a minimum amount of stable funding relative to the bank's liquidity needs over a 1-year horizon. Stable funding is based on the tenor of deposits as well as the type of depositor. So clearly, long-term deposits have greater stability than short-term deposits, and consumer or customer deposits tend to have greater stability than deposits from other banks. You need to learn these three key points related to the Basel III framework, and we'll be discussing them in more detail in the next section. Individual jurisdictions, regulatory authorities. So the point is that we have several global organizations such as the Basel Committee, and then there are other organizations we mentioned on the previous slide that deal with financial stability. These organizations do not have legal authority over banks in particular countries. So, for example, in the UK, banks will be regulated by an entity in the UK. In China, the regulator is the China Banking Regulatory Commission. So, these regulatory authorities in different regions work with the Basel Committee. So, they might even be on the Basel Committee. The Basel Committee establishes the framework. Regional regulators take that framework, they might make adjustments that are relevant for their country, and then these regulators ensure that the banks in their region are following the rules. There are several banks that are global. Such banks will have to work with regulators in different parts of the world. As an example, HSBC Holdings, which has operations all over the world, is regulated and supervised by approximately 400 different central banks and regulatory authorities. So let's understand what is meant by the camel's approach. This approach has 6 components which are shown here. The first is capital adequacy, and this addresses the question, does the bank have sufficient capital given its assets? The second component is asset quality. This deals with the quality of the assets a bank has. A bank typically has financial assets, and a major chunk there will be loans. The question is, what is the quality of those loans? The third component is management capabilities. Is the management strong? Is it not so strong? What's the track record? Then we look at earnings. What is the level of earnings? What is the quality of earnings? Are earnings going up or down? Then we look at liquidity. How strong is the liquidity position of the bank? What are the sources of funding? Are the sources of funding fairly stable? And then we look at sensitivity to market risk. Notice that we take the first letters here to come up with camels. So this C comes from capital adequacy, the A comes from asset quality, and so on. Now, as we consider each component, we come up with a rating. The rating is on a scale of 1 to 5, where 1 is the best rating and 5 is the worst. So if we look at capital adequacy and it looks like the bank is doing really well on this front, then we will assign a 1. If we look at asset quality and we believe that the asset quality is neither perfect nor too bad, it's somewhere in the middle, we might assign a score of 2.5. If management is very weak, then we would assign a 5, and so on. So we assign these ratings and then add up the ratings to come up with an overall camel's score. Now let's dive into capital adequacy in a little more detail. The core question when talking about capital adequacy is the following. Does a bank have adequate capital given its assets? So the ratio here is capital over assets. The regulator would want a relatively high ratio. So given a certain level of assets, the regulator will feel that the bank is safe if the capital is high. So all else equal, a high ratio would be considered good. But now there are 3 major questions here. One question is, what exactly do we mean by assets? So how do we calculate the denominator? Then how do we calculate the numerator? And the third question is, what is good enough? So what is the minimum ratio over which we can say that there is adequate capital? So let's start by addressing the denominator. What do we mean by assets? Here, it's important to understand the distinction between assets and risk-weighted assets. To understand this distinction, let's say we have 2 banks, A and B. Both have assets worth 100 million, but the distribution of assets is very different. A's assets are primarily government T-bills, so they are very safe assets, whereas B has primarily corporate loans, and these corporate loans have some risk. The question now is, does it make sense for us to have the same assets number for both banks? In other words, will the same amount of capital be sufficient for us to say that both these banks are safe? And the answer is no. Clearly, for bank B, which has more risky assets, we will need more capital. So the way we deal with this problem is by coming up with a number called risk-weighted assets. We consider the assets and we apply a risk weighting. According to the Basel III framework, there are several ratings given the type of asset, but we'll just talk about the three major weights. So one category is cash or cash-like assets. For this, the risk weight is 0. Then we have corporate loans. So here, the risk weight is going to be 100%. And we can have non-performing loans. So these are clearly the most risky, and therefore the risk weight is going to be more than 100%. Here, let's say the risk weight is 150%. Now imagine we have a bank which has cash equal to 10, corporate loans equal to 1,000, and non-performing loans equal to 10. So the total assets would be 1,020. But what are the risk-weighted assets? When we look at the risk weighting, for cash, the risk weight is 0. So the risk-weighted amount will be 0. For corporate loans, we are saying that the risk weight is 100%. So we do 1,000 into 100%, which would be 1,000. And then for non-performing loans, we are saying that the risk weightage is 150%. So we have 10 into 150%, which is 15. Here, we will come up with risk-weighted assets of 1015. So this is the process. Notice that if a bank has more risky assets, then the risk-weighted asset number will go up. In other words, this denominator over here will go up. Next, we look at capital. There are three types of capital. In the context of Basel III, we need to understand that there are three types of capital. The most basic is common equity tier 1 capital. So this is the safest type of capital. It is essentially common equity. And specifically, it includes common stock, issuance surplus related to common stock, retained earnings, other comprehensive income, and then there are certain adjustments that you don't really need to get into. The major point is that this represents the safest form of capital. Then we have other tier 1 capital. This includes instruments which have been issued by the bank, and these instruments need to meet certain criteria. Some of those criteria are shown here. One is that these instruments must be subordinate to deposits and other debt obligations. They should not have any fixed maturity. And if there are any interest or dividend payments, those payments should be at the bank's discretion. In other words, the bank should not have to make interest or dividend payments if it doesn't want to. Collectively, 1 and 2 are called total tier 1 capital. Then the third category is tier 2 capital. This is capital which meets certain criteria. Tier 2 capital must be subordinate to deposits and to general creditors of the bank. Tier 2 capital must have a minimum maturity of 5 years. So these are two criteria. There are other criteria too. Basel III identifies several other criteria, but if you just have a basic sense, that should be good enough. Collectively, these three are referred to as total tier 1 and tier 2 capital. So based on our discussion so far, we've addressed 2 of the 3 questions. We've addressed the question related to assets. We've addressed the question related to the definition of capital. The third question now is how much is enough? And here Basel III defines some minimum capital requirements. According to the Basel III framework, Common Equity Tier 1 capital must be at least 4.5% of risk-weighted assets. So if we have a bank with risk-weighted assets equal to 1,000, then Common Equity Tier 1 capital must be at least 45. So this would be the minimum requirement. More than 45 is better. So if this ratio goes up, that means that there is more than adequate capital, which is a good sign. The regulator will be happy. Then the second ratio is total Tier 1 capital divided by risk-weighted assets. This ratio must be at least 6%. So if we look at our total Tier 1 capital divided by risk-weighted assets, this number must be greater than 6%. The third ratio is total capital, which is Tier 1 plus Tier 2 divided by risk-weighted assets. This ratio must be greater than 8%. And again, the higher these ratios, the better. Coming now to example 1, we are given some numbers related to HSBC Bank. So we are given the three ratios that we just talked about, and we are also given the capital. So this is called regulatory capital. So we are given the Common Equity Tier 1 capital, the additional Tier 1 capital. So collectively these two would be our total Tier 1 capital. Then we have Tier 2 capital, and all these three combined would be the total regulatory capital, which is Tier 1 plus Tier 2. We are also given the risk-weighted assets for 2015 and 2016. The first question is, based on this exhibit, did HSBC's capital ratios strengthen or weaken in 2016? So if we look at 2015 and 2016, notice that the Common Equity Tier 1 ratio went up. The overall Tier 1 ratio went up from 13.9 to 16.1%, and the total capital ratio went up. So all the capital ratios strengthened. So that's the answer to the first question. The second question is, based on this information, what was the primary reason for the change in capital ratios in 2016? So now let's look at what's happening to the capital and the risk-weighted assets. Notice that the capital is actually coming down. So the Common Equity Tier 1 capital is down from 2015. Additional Tier 1 capital is also down. Total Tier 2 capital is down. And not surprisingly, the total regulatory capital is down compared to 2015. But the risk-weighted assets have come down much more. So the risk-weighted assets came down from about 1.1 million to 857. So this is a substantial decrease. Now, if you look at capital over risk-weighted assets, what's happening is capital is coming down by a small amount. Risk-weighted assets are coming down by a large amount. So overall, this ratio has increased. The answer, therefore, is that the primary reason for the change in capital ratios is the substantial decrease in risk-weighted assets between 2015 and 2016. The second component in the CAMEL's approach is asset quality. We've talked earlier about the fact that for banks, most of the assets are going to be financial assets. Now we go one level deeper. Within financial assets, there are going to be three major categories. One is highly liquid financial instruments. So these might be T-bills, for example. Then we have investments in securities issued by other entities. An example would be a bond that has been issued by another company. And then we have loans issued by the bank. And this tends to be the highest percentage of overall assets. When evaluating asset quality, we are concerned with credit quality and diversification. So with credit quality, we are looking at both existing and potential credit risk. We are also looking at how diversified our assets are. a higher level of diversification would imply a relatively lower amount of risk. For an analyst, it's important to understand the credit policies and the overall risk management process that a company is using, because that has a significant impact on asset quality. If the credit policies are strong and the bank is careful about who to issue loans to, then the asset quality is likely to be good. Also, these credit policies will fall under the larger umbrella of the risk management process. In terms of these three components here, let's talk about loans first. The quality of loans depends on the creditworthiness of the borrowers. Obviously, if the borrowers have strong credit, that would imply that the loans are relatively good quality. As an analyst, one should also look at the adequacy of adjustments for expected loan losses. If we believe that the adjustments are not sufficient, then that would imply low asset quality. On the other hand, if the adjustments are adequate, then that would be a positive sign in terms of asset quality. When evaluating investments in securities issued by other entities, we should recognize that the investments or these instruments are measured differently depending on categorization. So these investments can be measured at amortized cost, or they could be at fair value, where unrealized gains are recorded in other comprehensive income. And the third scenario is where these assets are recorded at fair value and unrealized gains and losses flow through the profit and loss statement. We will discuss how to evaluate the asset quality of these investments in section 3.3, but very briefly, what we can do is look at the losses. So for example, if an asset is being recorded at amortized cost, we can compare the amortized cost with fair value. If the fair value is lower than the amortized cost, then that would imply that perhaps the asset needs to be impaired, and this would be a negative sign in terms of asset quality. With this categorization, where the asset is being shown at fair value and unrealized gains and losses are shown in OCI, we can look at what the unrealized gains and losses are. If there have been significant unrealized losses, then that is a negative in terms of asset quality. And similarly with this third categorization, where unrealized gains and losses are moving through the profit and loss statement, if there have been several losses in the past, then that would imply relatively low asset quality. There are several ways in which asset quality can be evaluated. The curriculum presents two examples. In one example, we consider the composition of assets, and then in the next example, we look at credit quality. So let's take a look at example 2, where we consider asset quality through the composition of assets. We are given these assets for HSBC, and then the first question is, the following items are the most liquid: cash and balances at central banks, so that's this item; items in the course of collection from other banks, that's the second item; and Hong Kong government certificates of indebtedness. So these are basically government bonds, that is this item. What portion of HSBC's total assets was invested in these liquid assets in 2015 and then in 2016? Did the balance sheet liquidity decrease or increase in 2016? So these are the most liquid assets. We want to see what percentage of total assets are represented by these liquid assets. So for 2015, the percentage would be the sum of these three numbers divided by this number, and that is 5.5%. For 2016, we'll take the sum of these three numbers, divide by this number, and that is 6.9%. So this means that the liquidity improved, because as a percentage of total assets, the highly liquid assets went up to 6.9% in 2016. So did the liquidity decrease or increase? The answer is the liquidity increased. 2. How did the percentage of investments to total assets changed from 2015 to 2016? So the question is, what do we mean by investments? And the definition is given here. Investments means trading assets, so that's these. Then we have financial assets designated at fair value, that's over here, and financial investments. So financial investments are over here. So again, we'll take the sum of these three numbers, so this, divided by total assets, and then do the same for 2016. When we do the calculation in 2015, the sum of these three divided by the overall assets gives us 28.1%. And then in 2016, the number goes up to 29.3%. Then part 3, what portion of HSBC's assets are loans? The bank's loans include loans and advances to banks. So we have loans and advances to banks, loans and advances to customers. So that's this item. And then we have reverse repos. So reverse repos are shown over here. So these are the three items that fall in the loans category. What was the percentage of loans to overall assets? We take these three, divide by total assets. In 2015, the number was 48.2%. And then in 2016, we have these three numbers divided by this. That is 46.8%. So the percentage of loans went down a little. In example 3, we consider the credit quality of assets. So notice here, the different assets are categorized based on credit quality. Here we have assets that are neither past due nor impaired. And within this, we have strong credit quality, good credit quality, and so on. Then we have past due but not impaired. Then we have impaired, the total gross amount, impairment allowance, and total. And then over here, the various percentages are calculated. Now the first question is, based on this exhibit, did the credit quality of HSBC's financial instruments improve or deteriorate in 2016? Specifically, how did the portion of assets invested in strong credit quality instruments change from year to year? So we are concerned here with assets that are categorized as strong credit quality. If we look at 2015, the percentage will be this divided by the total assets, which is this number. In percentage terms, that is 69.2%. Then in 2016, strong credit quality would be this number divided by this number, which in percentage terms is 71.4%. So notice that the credit quality improved from 2015 to 2016. The next question is, does the change in HSBC's impairment allowances in 2016 reflect the change in the credit quality of financial instruments, specifically the amount of the impaired assets? So the answer here is yes, and we can look at this in multiple ways. Our credit quality has gone up and our impairment allowance has gone down. So it used to be 0.5%, now it is 0.4%. That makes sense. If our quality is up, that means our impairment allowance should come down. More specifically, what has happened here is the impaired amount has gone down from 1.2% to 0.9%, and this is a 26.9% decrease. So this is a good thing. Now, in line with this 29.6% decrease is the decrease of about the same amount in impairment allowances. So as we would expect, these two numbers are reasonably aligned. The third component of the camel's approach is management capabilities. The key question here is, what is the ability of a bank's management to identify and exploit profit opportunities while simultaneously managing the associated risks? If the bank management can do this well in terms of identifying good opportunities, taking advantage of those opportunities, and then managing the associated risks, then the bank will get a good score on this component. Now, other factors which are somewhat related to this are shown over here. We need to look at what is the governance structure. Do we have a strong governance structure whereby management is acting in the best interest of shareholders? Is management properly complying with laws and regulations? Are the internal controls strong? Is there transparency of management communications? And is the financial reporting quality good? So if all these other factors are also positive, then that would contribute to a good rating with respect to management capabilities. The fourth component is earnings. The major factors to consider are shown over here. One has to do with the level of earnings. So are earnings at a high level? And by high level, we want to know what is the return on invested capital relative to the cost of capital. So if the return on invested capital is high compared to the cost of capital, so cost of capital is basically the cost of funding. So if this difference is high, that means that earnings are high, which is a good thing. We should also look at the trend. So have earnings been trending up or not? We also need to consider earnings quality. So here we evaluate whether the accounting choices are unbiased, and we also should consider the sustainability of earnings. So if the accounting choices are unbiased and the earnings are sustainable, then we can say that the quality of earnings is good. So these are the major points: the level of earnings, the trend, and quality. Now some details which are primarily focused on quality. There are some areas where a fair amount of judgment is involved, and one of those areas is loan impairment allowances. Banks make most of their money by lending and then charging interest on loans. So some of those loans might end up being non-performing loans, which means that banks need to have loan impairment allowances. Analysts need to determine whether the allowances being used by a bank are sufficient. If the allowances are not sufficient, this means that later on there will be write-offs and earnings will come down in the future. Another area that requires judgment is fair value estimates. For certain types of securities, such as trading securities, the change in fair value impacts net income. Now the question is, how do we figure out fair value? There will be some cases where the fair value is determined based on market prices, but there will be other cases where the fair value has to be estimated. In these cases, an analyst needs to determine how well a bank is estimating fair value. If the process for estimating fair value is not very strong, then that will compromise the quality of earnings. The third point has to do with composition of earnings. With most banks, the earnings will come from three major sources. One is net interest income, the second is services, and the third is trading income. The net interest income is the difference between the interest that a bank gets on its loans and the interest that a bank pays its depositors. Services income is the income that a bank gets based on the various services that it offers customers. And then we have trading income. These top two components, net interest income and services income, tend to be more stable, whereas trading income tends to be volatile. So if a bank has a large percentage of its income coming from trading activities, then that would imply volatile earnings, which means that the quality of earnings is not very good. On the other hand, if the bank is getting most of its income from stable sources, that would be a positive sign. Now let's look at example 4, which focuses on the composition of earnings. So here the top 3 rows are the most important. We are looking at the net interest income, the net fee income, this is the services income, and the net trading income. The first question is, based on this exhibit, what is HSBC's primary source of operating income and what portion of total operating income was earned from this source? So if we look at 2016, the largest chunk is coming from net interest income. So net interest income as a percentage of total operating income is 49.8%. So 49.8% is coming from net interest income. This is a positive sign because net interest income is quite stable. The second question, what percentage of total operating income did HSBC earn from trading income? So this would be 9452 divided by this total operating income, and that is 15.8%. So notice this is much lower than the percentage of income coming from the most stable source. The third question is, describe the trend in HSBC's operating income. So if we look at operating income in 2012, it was 82545, and notice the number has been going down steadily. So the trend is downwards. We also want to look at whether there are any changes in the components as a percentage of total operating income. For that, we need a common sized statement, and we have that over here. All these numbers have been derived from the previous exhibit. Notice that net interest income was about 45.6% in 2012, and it stayed in roughly that range. So net interest income has been between 45 and 50%. The net fee income has ranged between 19% and about 21.5%. So this has also remained in a fairly narrow range. And trading income has gone up though. So the trading income has increased from 8.6% to 15.8%. The fifth component of the camel's approach is the liquidity position. A bank's failure to honor a current liability could have a systematic impact, and therefore it is extremely important for banks to maintain a strong liquidity position. The question now is, how do we evaluate and measure the liquidity position of a bank? Here we have two major considerations. The first is the amount of liquid assets relative to near-term expected cash flows, and the second is the stability of the bank's funding sources. Let's take the first item here, liquid assets relative to near-term expected cash flows. The relevant ratio that we can use to evaluate this item is the liquidity coverage ratio, or LCR. This is the ratio of highly liquid assets to expected cash flows. Now, these expected cash flows are the cash flows that would happen in a 1-month period under a high stress environment. So we want to make sure that the bank has enough liquid assets to meet this cash flow if it does happen. Basel III sets a target minimum of 100%, which means that our liquid assets should at least be equal to this expected cash flow over a 1-month period if there is a high stress scenario. The relevant ratio which measures the stability of the bank's funding sources is the net stable funding ratio, or NSFR. This is equal to the available stable funding divided by the required stable funding. The available stable funding is based on the sources of funding. So this is based on the capital and liabilities of the bank, whereas the required stable funding is based on the asset structure of the bank. So the larger point here is that we want a relatively high amount of available stable funding. So if there is an economic crisis or a stress scenario, we don't want the sources of funding to suddenly dry up. This is what happened in the 2008 crisis, and Basel III introduced this measurement after that crisis. Now, how do we come up with this available stable funding? The rough guideline is given in the curriculum. So with respect to the capital and liabilities, we have different categories shown here. Each of these categories has an available stable funding factor. So we figure out how much is in each category and then multiply by the factor. You don't need to know all these details. You just need to recognize that this information is coming based on the capital and liabilities. And obviously, if we have more stable funding, such as this item would be considered more stable, the factor is high. For items that have relatively low stability, the factor would be low. So based on these factors, we come up with the numerator, and the denominator is based on the structure of assets. Here again, Basel III sets a target minimum of 100%. Some other factors to consider when evaluating liquidity position. One is the concentration of funding. So obviously, we don't want highly concentrated funding. If a bank is getting most of its funding from a single source, that would be risky. We also need to look at contractual maturity mismatch. So the idea here is that a bank has liabilities such as deposits and a bank has assets such as loans. With respect to deposits, there are expected payments that we need to make. And with respect to assets such as loans, there are expected payments that we'll receive in the future. We need to figure out whether these two match. So ideally, large outflows should match the large inflows. So if we have major payments to make, those payments should match with the major inflows of cash that we expect in the future. If this is not happening, whereby, let's say, major payments need to be made in the short term, but major inflows will come in the long term, then that would imply a liquidity problem. Let's look at example 5 now. In this example, we are given the LCR and NSFR for HSBC's operating entities. The question is, based on this exhibit, which of HSBC's operating entities had the highest level of liquid assets relative to its liquidity needs in a stress scenario? So when you read this, you need to immediately figure out that they are looking for the LCR. The LCR is the liquidity coverage ratio, and the question is related to 2016, so we look over here. The higher the LCR, the better, which means that the bank has a greater ability to meet the liquidity needs in a stress scenario. So we look at these numbers and pick the highest one. So this operating entity, HSBC China, has the greatest ability to meet liquidity needs in a stress scenario. Next, which operating entity had the most stable funding relative to its required need for stable funding? Here we need to look at the NSFR and we want to find the entity with the highest ratio. So again, looking at all these numbers, 162 is the highest. So we can say that Hang Seng Bank has the highest ratio. So it has the most stable funding relative to its required need for stable funding. Number 3. Which of HSBC's operating entities is the furthest away from achieving the Basel III target for NSFR? The target is 100%. Furthest away means which entity has the lowest NSFR. If we look at the various numbers here, the lowest number is 49. So HSBC Bank China is the furthest away from achieving the Basel III target. We now come to the sixth and final component of the CAMEL's approach, which is sensitivity to market risk. Market risk is the exposure to changes in market rates being interest rates, exchange rates, equity prices, or commodity prices. The exposure to changes in market prices arise because of mismatches between deposits and loans. So all entities have exposures to these market prices, but banks have exposure because there is a mismatch between deposits and loans. So a bank's liabilities are generally deposits. So deposits tend to be the largest percentage on the liability side. And then we have assets here. Typically, the largest contributor would be loans. And there is often a mismatch over here. The deposits tend to have a relatively short duration, whereas loans tend to have a long duration. When there is a change in interest rates, because of the difference in duration, the impact on liabilities and on assets is different, and that creates a mismatch. Mismatches could also be because of differences in repricing frequency, difference in reference rates, and differences in currency. Let's look at example 6 now, which highlights the most important market movement in the context of banks, which is interest rates. So banks have to do an analysis, which is basically what will happen to the net interest income if there is a change in interest rates. And the scenario analysis we've done here says that if there is a plus 25 basis points change in interest rates, then what will happen to net interest income? The answer is the net interest income will go up by 1709. On the other hand, if there is a 25 basis points decrease in interest rates, then the net interest income will come down by 2406. So this is the information given. Let's look at the questions. By how much would HSBC's planned net interest income decrease if the yield curve shifts downward by 25 basis points at the beginning of each quarter for 4 quarters? So we need to look here and we need to look at the total amount. So the answer is net interest income will decrease by 2406. Next, if a decrease in interest rates would hurt the earnings of banks such as HSBC, why would central banks lower interest rates so significantly following the financial crisis in order to prop up the financial sector? Now, the answer is that this information is based on a static relationship between assets and liabilities. Obviously, if there is a financial crisis and interest rates are changing, then the structure of assets and liabilities will change. Also, when we have interest rates that are significantly lower, then generally with deposits, the interest rate becomes effectively zero, which means that the cost of funding for banks is effectively zero. On the asset side, there will be an interest rate. The interest rate might be small, but it is still positive, and it would be obviously greater than zero, which implies that there is still a major benefit for banks in this situation, which means that banks are still fairly well off even if interest rates come down substantially. Another larger reason why central banks would reduce interest rates would be to stimulate the economy and help it come out of a recession. The camel's approach for analyzing a bank is good, but it is not 100% comprehensive. Therefore, we should also consider some other factors. Broadly speaking, the other factors could be banking specific, or these other factors could be relevant for any company, including banks. So let's first consider the banking specific factors. One very important factor is whether the bank will enjoy government support if there is an economic crisis. If we believe that the bank will indeed enjoy government support, then that is a positive in the sense that the bank then is relatively safe compared to other banks which will not enjoy government support if there is a financial crisis. So the question now is, how do we know whether there will be government support? There are two broad areas to look at here. One is the size of the bank, and the other is the status of the country's banking system. If the bank is very large, then chances are that it is extremely important for the economy, and therefore it is more likely that the bank will get support from the government. The other factor is the status of the banking system. Now, if we have a very strong banking system and a particular mid-sized bank can fail without compromising the banking system, then chances are that that particular bank will not get too much support from the government. Next, we come to government ownership. In some countries, governments have a stake in certain banks. So when we are analyzing a bank, we should look at whether there is a government stake or not. If there is a reasonable government stake in a bank, then again, chances are that if there is an economic crisis, the bank will be supported by the government. Next, we come to the mission of the banking entity. Different banking entities can have very different missions. We might have large global banks such as HSBC that we've discussed in the last section, or we might have community-centric banks. The dynamics of the community-centric banks depends highly on the communities that they serve. So if we have a community-centric bank supporting farmers in a particular state, then the economics of that state will have an impact on the bank, the sorts of assets and liabilities that the bank will have, and so on. So understanding the mission and how the mission is being executed is important when analyzing a bank. The corporate culture is also important. So we need to analyze whether the bank has an aggressive risk-taking culture or whether the bank is exceedingly risk-averse. If a bank is risk-averse, then chances are that the return on capital is going to be low. On the other hand, if a bank is taking excessive risk, then the earnings are likely to be very volatile. So how do we determine the corporate culture? There are some areas to look at. We can look at the types of exposures the bank has. If the bank has a few concentrated exposures in risky areas, that would imply that the bank management is maybe taking too much risk. We can also look at whether financial statements have been restated multiple times. That would point to weak internal controls. We can also look at the type of equity-based compensation given to senior management. If senior management has above average stock options or equity-based compensation, then that might lead to risk-taking behavior. We can also look at whether there have been significant asset write-downs. If this is indeed the case, whereby the bank has had significant asset write-downs, that means that the bank probably is not very conservative in terms of recognizing potential losses. Moving now to analytical considerations not addressed by camels that are also relevant for any company. So these considerations are important for banks, but they also apply to any company. The first one is competitive environment. So what is the competitive environment in which our bank is operating? A bank might be a global bank competing with other large global banks, or a bank might be operating in a particular region. We need to figure out who the competitors are and what are the competitive forces that are in play. Analyzing off-balance sheet items is very important. These can represent obligations which are not clearly stated on the balance sheet. The off-balance sheet items might be complicated in terms of highly engineered derivative instruments, or they can be less complicated in the form of operating leases. In any case, they represent payments that a bank might need to make or exposures that the bank might have, and therefore they must be analyzed. The curriculum points out an important area that is relevant for banks, which is assets under management. So banks might have an asset management operating unit which is managing the assets of clients. Obviously, the assets under management belong to the client, therefore they don't show up on the bank's balance sheet. However, the size of the asset base impacts the fees that the bank earns. And therefore, understanding how big this asset base is, whether it is growing or whether it is, that determines the level of fees that the bank will be earning. If a bank is disclosing segment information, this needs to be studied. Most large banks will have several lines of business, and analysts should study the different lines of business and determine whether capital is being allocated appropriately across the different lines of business. Ideally, we would want more capital allocated to the lines of business that have relatively high profitability. Currency exposure is an issue for large global banks. Now, let's take a simple example where we have a large bank and it has several foreign subsidiaries. Now, if we have a situation where the functional currency of a foreign subsidiary goes down relative to the reporting currency of the bank. Now, if this happens, that will have a negative impact on the capital of the bank. Therefore, understanding the various currency exposures is important. In their annual filings, companies report risk factors. These should be evaluated. Also, banks make detailed Basel III disclosures. These should also be studied. In this section, we will apply the CAMEL's approach to analyze Citigroup. And as a quick reminder, with the CAMEL's approach, we look at these 6 areas: capital adequacy, asset quality, management capabilities, earnings, liquidity, and sensitivity to market risk. For each of these components, we will allocate a rating, and then those ratings will be added. While this might sound formulaic, but keep in mind that a fair amount of judgment is involved in allocating ratings to each of these components. Another important point is that our perspective or our focus can be quite different depending on whether we want to make an equity investment or a fixed income investment. For an equity investor, earnings will be very important. So we would be concerned about return on capital relative to cost of capital. We would be concerned about whether earnings are trending up or not. We would also consider the quality of earnings. For an equity investor, capital adequacy might not be so important. On the other hand, for a fixed income investor, capital adequacy would be extremely important, because capital adequacy gives a sense for the relative safety of the bank. So let's dive into the first component, which is capital adequacy. Now here, recall that there are 3 ratios that we look at. The first ratio is common equity tier 1 capital divided by risk-weighted assets, and according to the Basel III framework, this needs to be at least 4.5%. Then we have total tier 1 capital to risk-weighted assets, and according to Basel III, this should be at least 6%. And then we have total capital divided by risk-weighted assets, and this should be at least 8%. So let's see how Citigroup is doing. In 2016, the ratio is 14.35%. This is down slightly from 14.6%. So notice here we are working with common equity tier 1 capital. You don't need to know all these details, but on Citibank's balance sheet, these are the components of common equity tier 1 capital. Then we have the total risk-weighted assets over here. The ratio of this number, which is the tier 1 common equity divided by risk-weighted assets, gives us 14.35%, well above the minimum of 4.5%. So we are in good shape. This item is highlighted because there was a substantial change between 2015 and 2016, and that is what caused the ratio to change a little bit, but in general, we are safe over here. Then we come to the second ratio, which is total Tier 1 capital ratio. So we look at the total Tier 1 capital, which is this number, divide by the total risk-weighted assets, which we have from the previous slide, and this gives us 15.29%, which is higher than what we had in the previous year. And again, the numbers are well above the 6% minimum. The third ratio is total capital divided by risk-weighted assets, and this ratio is also quite safe. The total capital divided by risk-weighted assets is 17.33%, which is much higher than the required minimum of 8%. So in terms of capital adequacy, Citigroup is doing really well. On a scale of 1 to 5, where 1 is best and 5 is worst, we can say that Citigroup gets a 1 on capital adequacy. We'll now discuss asset quality. The curriculum presents a tremendous amount of information. What I'll try to do is emphasize the most important points. So the first thing we do is look at asset composition. Here we understand what percentage of the assets are highly liquid, what percentage are investments, and then what percentage are loans. Highly liquid assets tend to be relatively low risk, investments tend to be medium risk, and loans often tend to be relatively high risk. After the asset composition review, we look at the investments. In the case of Citigroup, we will be focused on available for sale securities and held to maturity securities. With available for sale securities, they are reported at fair value, and unrealized gains and losses are shown as part of other comprehensive income. With held to maturity, we simply show the securities at amortized cost, and unrealized gains and losses are not reported. But in any case, we do want to know what the unrealized losses are. In the case of held to maturity securities, if the unrealized losses are significant, then the question will be, why has the company not impaired those securities? We are also concerned with the aging of unrealized losses. If the unrealized losses are relatively old, specifically if they are older than 12 months, then we would be concerned, because if losses are old, it's less likely that they will reverse. A major chunk of our analysis will be focused on loans. Here we are concerned with how collectible are the loans, and are the allowances that the company is using reasonably stated. To evaluate this, there are three important ratios. These are the allowance for loss ratios. One ratio is allowance for loan losses divided by non-performing loans. Notice in this ratio, the numerator is subjective. It is basically management's judgment in terms of how much allowance to use. And then non-performing loans is more objective. So these are actual loans which are not performing, where the borrowers are not returning money as per schedule. The other ratios are similar. So here we have allowance for loan losses divided by net loan charge-offs. And the third ratio is provision for loan losses divided by net loan charge-offs. In all these cases, the numerator is subjective and the denominator is more definitive. The allowance term basically is a balance sheet term. So this is a contra account that reduces the value of loans. The third item here, provision for loan losses, is an income statement item. Now let's go through the analysis. Here we look at the relative percentages of the different types of assets. So if we take our liquid assets that tend to be low risk, in 2016 the number is 37.4%, slightly higher than what we had in 2015. So that's a relatively high number, which makes us feel a little safe. Investments are about 19.7% and loans are 34.2%. Here we look at the investments. Specifically, we are concerned on this slide with debt securities that are available for sale. The first item to look at is the amortized cost versus fair value. These two numbers are quite similar. The unrealized gains and losses are relatively small. So there is a very small amount of unrealized loss. It is about 0.9%. The unrealized gains are 0.6%. So the net amount is 0.3%, which is quite small. So this is not a major concern. The only item where we have substantial unrealized losses are over here. These are state and municipal securities. So not a major issue. A related item that we look at is the aging schedule. And based on the information provided, 54% of the losses are less than 12 months old, which means that 46% of the losses are more than 12 months old. The older the losses, the less likely that they will reverse. So this is a bit of a concern. Then we look at HTM or held to maturity securities. These total 457 million. So the numbers are much lower than what we have with available for sale securities. This 457 million is only 1.3% of the amount invested. Of this number, 82% stemmed from held to maturity securities that are showing losses older than 12 months. So even though the 457 million number is small, but the aging is a problem because most of the losses are older than 12 months, and that means that it is unlikely that the losses will recover. So the question here is, why has the company not impaired these assets? On this slide, we look at the loans, and specifically we are focused on the three ratios that we talked about earlier. I won't get into all the details, but over here we have the relevant data to calculate the ratios, and then the bottom segment of the screen actually calculates the ratios. So the first ratio is allowance for loan losses divided by non-performing loans. Citigroup refers to non-performing loans as non-accrual loans. Now the information is divided between the consumer segment and the corporate segment. So these are two different segments, therefore we want to evaluate them separately. Let's take the consumer segment. Notice that the ratio has been going up slightly. So 2.47 in 2012 and it's up to 2.96 in 2016. Now this is a positive sign. It means that the allowance is going up relative to non-performing loans. This is a conservative strategy. There is more buffer for the allowance for loan losses, and as an analyst, that makes us feel more comfortable. The point is that the buffer for loan losses is relatively high in 2016 compared to earlier years. On the corporate side, the story is a little different. Here the number is actually lower. It's 1.12, which is lower than 1.75 and 2.04. That implies that here the buffer is thin. So there's a concern as to whether there is sufficient allowance for loan losses relative to the non-performing loans number. Then we move to the second ratio, which is allowance for loan losses divided by net loan charge-offs. On the consumer side, we seem to be okay. The numbers are generally stable in the 1.5 range. So if you look at these numbers, they vary between approximately 1.39 and the highest number is 1.65. So these numbers are in a relatively narrow range. The number is higher than 1, which implies that the allowance for loan losses is generally higher than the net loan charge-off. On the corporate side, if we look at 2016, the number is 5.26. So this in of itself is a relatively good number because it shows a high buffer, a high allowance for loan losses relative to net loan charge-offs. But the concern is the downward trend. So the numbers were higher in earlier years, and relative to these higher numbers, we are now much lower. So there is some concern as to why this number has come down so much compared to previous years. Then we have the third ratio, which is provision for loan losses divided by net loan charge-offs. On the consumer side, the numbers seem okay. So we would expect the provision for loan losses to be highly correlated with net loan charge-offs. We notice that these numbers generally are around 1. In earlier years, the numbers are slightly below 1. In 2016, the number is 1.05. So here, the provision for loan losses is slightly higher than the net loan charge-off. That is a conservative sign, so that makes us a little comfortable. On the corporate side, the story is a little different. Here, the provision for loan losses divided by net loan charge-off is 0.83. So the provision is less compared to the net loan charge-off. Also, if we look at earlier years, the provisions seem to be quite low over here in 2013 and 2014. And then a major adjustment had to be made in 2015. So there are some concerns over here. Now the question is, what score should be assigned to asset quality? Remember, our range is 1 through 5, where 1 is great, 5 is bad. And what we can do is, now based on the information provided, we have mixed signals. There are some indicators that imply that asset quality is good, others that imply that asset quality is not so good. So it might be appropriate to give a score somewhere in the middle, which would be 2.5. Next, we come to management capabilities. As with asset quality, external investors can only observe circumstantial evidence. So based on this circumstantial evidence, external investors can determine whether management capability is good, bad, or average. Some of the major points with respect to management capabilities are highlighted here. We look at Citigroup's 2016 proxy, and based on that, there are some items that stand out. Citigroup aims for 2/3 board representation of independent members. So this is a positive because the general guideline is 50% independent members, whereas Citigroup is going for 2/3 independent members. Also, the role of the CEO is separated from that of the chairman of the board. These are two separate people. That again is a positive. The risk management committee met frequently. This is also a positive. So from an overall governance perspective, Citigroup seems to be doing well. We should note, however, that this doesn't necessarily mean that management is performing well. However, this does mean that the environment is being provided for management to perform well. We also look at related party transactions, and there are several related party transactions that would generally be a concern, but for an entity which is the size of Citigroup, one would expect related party transactions. So this is okay. Citigroup's auditor has given an unqualified opinion with respect to the system of internal controls. So this is a positive. An unqualified opinion is the best opinion an auditor can give. But this, again, is no guarantee that everything is perfect. Earlier, we looked at the quality of assets. Now, this is an indicator of management's capabilities. High quality assets would be an indication of high quality management. Now, in the case of Citigroup, we observed that the quality of assets was medium. So that is a slight negative in terms of management capabilities. Overall, though, we are generally positive. So on a scale of 1 to 5, where 1 is excellent, we will put Citigroup at 2. Moving now to earnings, and this would be particularly important for equity investors. When evaluating earnings, we are concerned with the quality of earnings, and a major indicator of quality is sustainability. So how sustainable are the earnings going to be? When we talk about sustainability, there are two major questions. The first one is is there any fine-tuning of discretionary estimates? Ideally, we don't want fine-tuning. The second question is, what is the reliance on non-recurring and volatile sources of revenue? Here, if the reliance on non-recurring and volatile sources is high, that would be a negative for sustainability. On the other hand, if the reliance is low, then that would be a positive with respect to sustainability of earnings. Now, for Citigroup, some specific areas that we look at are shown here. In order to determine whether there is any fine-tuning of discretionary estimates, we will look at historical pre-tax income relative to the provision for loan losses. This item is highly discretionary, so we want to look at how this changes with income over several years. We will look at trading income as a percentage of total revenue. As we've discussed before, trading income tends to be volatile, so we want to determine whether this volatile component is trending up or down or whether it is flat. And then we will evaluate net interest income. For most banks, a major component of revenue is net interest income, and this also tends to be relatively stable. To evaluate net interest income, we will look at the assets and the interest that is being generated from assets. We'll also look at liabilities and the interest that needs to be paid there. The difference between interest received on assets and interest paid on liabilities is the net interest income. So we need to figure out whether this number is trending up or down. Here we look at historical pre-tax income and provisions for credit losses. So we have the pre-tax income over here from 2011 through 2016. From 2011 to 2016, the pre-tax income increased by 6,381. Here we have the provision for credit losses. We also have the change for each year. Generally, the change has been negative, which means that the provision for credit losses has been decreased in each of these years. Over the 5-year period, the total provision for credit losses was decreased by this much, 5,377. Now, the curriculum makes several points, but I want to highlight the most important one, which is that the change in provision for credit losses, so this decrease of 5,377 is 84% of the change in pre-tax income. So we can say that pre-tax income over these 5 years went up by this number, but most of this number is coming because we reduced the total provision for credit losses. So this is not a very positive sign. This is saying that the increase in income is not very sustainable because we can't just keep reducing the provision for credit losses. So this would be something that an analyst would be concerned about. Next, we look at the 5-year summary of composition of Citigroup's revenue. So the major sources of revenue are shown here. We have net interest revenue, we have trading income, and then all other interest revenue. What we are concerned about here is the percentage of revenue that is coming from trading income. Trading income tends to be the most volatile. So if more and more revenue is coming from trading income, that would be a cause for concern. And when we look at the numbers here, they are trending upwards. So in 2016, trading income accounted for 10.9% of total revenue, which is higher than what we had in previous years. So this would be something that we would be concerned about. Here we are looking at the assets and then the interest revenue on assets and the percentage. The curriculum makes a few points here, but I feel that going into details is an overkill. Just recognize that when we are doing a detailed analysis of a bank, we need to understand what all the assets are, what is the interest revenue we are getting, and what are the rates, where are the rates high, where are the rates low, and how are numbers changing over the last few years. We need to do a similar analysis on the liability side. Here again, we can look at what interest payments we are making against which liability, what are the rates, and how are the numbers changing. From a testability perspective, it's important to understand what's happening to the net interest income or net interest revenue. So notice the numbers are given over here. So for the total entity, the net interest income has actually gone down. In 2015, it was 2.93%. In 2016, it's down to 2.86%. So this would be a cause for concern. Now, the question is what overall rating to give. The earnings are there, but not everything is positive. Recall that the first item we looked at, which was provision for loan losses as a percentage of overall change in earnings, that was a very high 84%. So that is a negative. Also, the percentage of revenue coming from trading was trending upwards. And when we look at net interest income, that has trended down slightly. So on a scale of 1 to 5, we need to be closer to 5. So the rating that we can give here is a 3. We'll now discuss the liquidity position. Liquidity is important for a particular bank, the banking system, and potentially the whole economy. Why is it important for a bank? The reason is obvious. We don't want a situation where depositors are coming to the bank to withdraw their money and the bank does not have enough cash to give money to depositors. With respect to the banking system, we need to recognize that banks have a lot of interactions with each other. So banks lend and borrow. So there is a substantial amount of lending and borrowing that happens in the interbank market. When we are working with derivative instruments, banks take counter positions with other banks. So if one bank has a liquidity problem, that will impact other banks in the system. And potentially, if the banking system is compromised, then that hurts the entire economy. So given the importance of liquidity, we can say that for a bank to simply meet its minimum capital requirements is necessary but not enough. In addition to meeting the capital requirements, a bank must have sufficient liquidity in the form of cash or near cash instruments in order to meet obligations. Earlier, we talked about two important ratios to measure the liquidity position of a bank, and now we will use those two ratios to evaluate Citigroup's liquidity position. The first ratio was the liquidity coverage ratio, which is shown here. The liquidity coverage ratio is equal to the high quality liquid assets. So let's just say liquid assets divided by net outflows. The net outflows are the outflows that would happen over a 1-month period in a stress scenario. Now, the requirement is that this ratio should be at least 100%. If we look at Citigroup, the ratio was 113% in 2015, and then this number has gone up to 120%, and on 31st December 2016, it's 121%. So it is well above the minimum requirement of 100%, and it's also trending up. So that is a positive sign. What about the other ratio? This is the net stable funding ratio. The net stable funding ratio is basically the available stable funding divided by the required stable funding. The available stable funding is based on the sources of capital or sources of funding, which is basically the liabilities and equity. So for Citigroup in 2016, the total available stable funding is 1341.5. The required stable funding is based on the assets, and that number is 1120. The ratio for 2016 is 120%. And this number has been in the same range since 2015. So here again, we are quite safe. The ratio is good, and we can therefore say that Citigroup's liquidity position is quite sound. The rating we can assign is 1. Sensitivity to market risk. The key question to address here is, what is the impact of adverse changes in interest rates, exchange rates, and other market factors on a bank's earnings and balance sheet. The sensitivity to market risk can be estimated using VAR, which is value at risk, and capital ratio sensitivities. VAR is discussed in detail in other parts of the curriculum, so I'll not explain the VAR metric over here, but in very simple terms, the idea is that it measures the value at risk given a certain probability and over a certain period of time. The higher the VAR, the greater the riskiness, and obviously if VAR is low, then the riskiness is low. Another point with VAR is that it is useful for intra-company analysis. So if we are comparing different divisions or different portfolios for a given bank or a given company, then using VAR makes sense as a comparison tool. But we cannot use VAR on an intercompany basis. So you might have three different companies, A, B, and C. They all report VAR, but their assumptions behind VAR might be different, which is why the comparison would not be an apples to apples comparison. The other metric is basically sensitivity disclosures, and what Citigroup does is it discloses sensitivity to capital adequacy ratios if there is 100 million change in the capital, and then we assume 100 million change in each of the three types of capital that we've discussed earlier. Also, we look at the sensitivity if there is a 1 billion change in risk-weighted assets. So now let's look at the numbers for Citigroup. We'll start with the VAR numbers. A fair amount of detail is given, but let's focus on the final VAR numbers shown here. So these are the total trading and credit portfolio VAR. Notice that the 2015 average was 117 million. The 2016 average is 92 million. Now this is saying that the number has gone down, which is positive. So that implies less risk over here. We should also look at total VAR as a percentage of net income from continuing operations and VAR as a percentage of common equity. Notice that these numbers are extremely small. So as a percentage of net income, we have 0.7%. As a percentage of equity, we have 0.1%. So these numbers are close to zero, which means that the riskiness is quite low. We can therefore assign a rating of 1. On this slide, we look at Citigroup's capital ratio estimated sensitivities. So what's happening here is we are considering the three types of capital. So we have common equity tier 1 capital ratio and total capital ratio. We talked about these three types of capital when we were discussing capital adequacy. Now with the common equity tier 1 capital ratio, the actual ratio is 14.35%, which is much higher than the requirement of 4.5%. If there is a change of 100 million in common equity tier 1 capital, the impact on the ratio is only 0.9 basis points. Notice here that Citigroup gives numbers based on the advanced approach and standardized approach. Understanding the difference between these two is beyond our scope. We can just focus on the standardized approach. The larger point here is that the impact of all these changes, so a 100 million change in common equity tier 1 capital or a 1 billion change in risk-weighted assets, so these numbers are very small compared to the buffer that we have. The actual ratio is much higher than the minimum. Even if the ratio changes by 0.9 basis points or 1.3 basis points, we are still quite safe. This implies that our sensitivity to market risk is low. Therefore, we can say that in terms of sensitivity to market risk, we can allocate a score of 1. Now let's look at the overall CAMEL's assessment. We've considered our 6 components, so capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risk. And for each of these components, we allocated a rating. When we add these numbers, we get 10.5. If we want to bring this down to the scale of 1 through 5, we can divide 10.5 by 6 because we have 6 ratings. That gives us 1.75, which is roughly here. So this is one way of coming up with the total score where we have an equal weightage for each component. But what if we are evaluating Citigroup from an equity perspective and we want to put greater weightage on asset quality and earnings? So in that case, we can use this weighting scheme where we have a weightage of 2 for asset quality and earnings, and all the other components have a weightage of 1. So this 2.5 then becomes 5, and this 3 becomes 6. The total number then is 8 because we have 2 and 2 from here. The sum of all these numbers is 16. And then if we want to bring this down to the camel's score, which is on a scale of 1 to 5, we need to divide 16 by 8. That gives us 2. So notice this number is closer to 5 than 1.75. And that is saying that if we give a heavier weightage to asset quality and earnings, then the rating is not as good as it would otherwise be. So that is it in terms of the camel's assessment for Citigroup. Analyzing an insurance company. Let's start by understanding some high-level differences between the banking industry that we've been talking about and the insurance industry. Compared to banks, cross-border business is low. So with banks, there is a lot of interaction between banks in different parts of the world, and large banks also have operations in different countries, and there is a lot of capital that moves back and forth between these different operations. With insurance companies, the cross-border business is relatively low. Even when large insurance companies have foreign branches, generally these foreign branches are required to keep their assets locally. So, for example, if an American company has a foreign branch in Germany, generally the assets will be maintained in that country. The reason is these assets are required to cover the liabilities that are raised in that particular country. Also, with insurance companies, there is no global standard like Basel III. So in the banking environment, Basel III is applied by banks all over the world. With insurance companies, there isn't a standard like Basel III, which is global. Instead, every jurisdiction will have its own particular regulation and standards. Now let's understand the insurance business a little bit. We have an insurance company. The main business of an insurance company is to sell protection. So an insurance company will sell protection to an insurance buyer, and in exchange for this protection, the insurance buyer is going to pay a premium. Notice that selling protection is the same thing as taking on risk. So in exchange for this premium, the insurance company is taking on certain risks of the insurance buyer. Given this discussion, it should be obvious that one of the major sources of revenue for an insurance company would be these insurance premiums. Now, there is another major source of revenue which is called investment income earned on float. What does this mean? The insurance company receives this premium, and ultimately insurance companies need to make payments to cover any losses that happen to the insurance buyer. So if an insurance buyer is buying car protection or auto protection, when there is an accident, the insurance company needs to make a payment. But there will be a time lag between receiving the premium and making payments to the insurance buyer. That time lag is called the float. During this float, the insurance company can take the premium amount and invest it, and the return on that investment or the investment income is another source of revenue for insurance companies. There can be other sources of revenue, but typically these two sources are the major ones. In terms of types of insurance companies, there are three major categories. One is property and casualty insurance companies. Then we have life and health insurance companies, and then reinsurance companies. Reinsurance companies sell insurance to other insurance companies. The focus of this reading, however, is only on the first two categories. We will not be covering reinsurance companies. When evaluating a property and casualty insurance company, we should understand its operations, its earnings characteristics. In this context, we need to understand the key ratios that are used to evaluate insurance companies. We should understand what their investment returns are. So what sorts of investments are being made and what are the returns that are being achieved. What is the liquidity position of the company and what is the capitalization position. So let's start with operations. First, let's understand the distinction between property and casualty. Property insurance companies protect against loss or damage to property. So, for example, homeowners in Florida might buy hurricane protection for their homes, or somebody might buy auto insurance. That would be an example of protecting property. Casualty insurance, also called liability insurance, provides protection against legal liability related to a third party. Now, going back to our auto insurance example, with auto insurance, we have two components. One component is protection against damaging your car. So if you get into an accident, the car is damaged, the property insurance component takes care of the cost related to the damage of the car. But what if you injured a passenger or you injured a bystander? The casualty insurance protects against those damages, the damages related to the bystander or the passenger. When an insurance contract is written, the premiums are collected at the start of the contract. So that is a source of revenue that we've talked about. Now, the premium can be invested during the float period. So as we've discussed, we get money at the start of the contract. The actual cost to the insurance company will happen sometime later. So in the context of auto insurance, the money is collected right up front. The accident might happen at some point in the future. So in between, the insurance company has this float period and the premium amount is invested during that float period. The return on that investment then becomes one component of revenue. In order to minimize their payouts, insurance companies need to be prudent about the underwriting process. What this means is insurance companies need to carefully understand the risks that they are taking and then make sure that the premium being charged is more than adequate to cover the risk that they are taking on. Another aspect of prudent underwriting is diversification. So going back to an example I discussed earlier, let's say an insurance company only writes insurance contracts related to hurricane damage in Florida. Now, this is lack of diversification. If a hurricane hits Florida, there will be lots of claims and this insurance company will be in trouble. On the other hand, if the insurance company writes lots of different contracts where the underlying adverse event is unlikely to happen at the same time for the different contracts, then that is an example of diversification. With property and casualty insurance companies, the policies are typically annual and the final cost is usually known within the year of the covered event. So if a covered event has to do with auto insurance, then the premium is received upfront, the contract is typically for 1 year, and if there is an accident or any damage caused to a third party, that is known within this period. And therefore, the cost to the insurance company is also known. This is the typical example. There might be some scenarios where the cost comes later, but by and large, with property and casualty insurance companies, we have 1 year contracts and the cost is known during the 1 year. These contracts are then renewed every year. With property and casualty insurance, the claims tend to be unpredictable and lumpy. So going back to our hurricane in Florida example, Obviously, hurricane damage will not happen every year. If we look at the last 20 years, there will be major hurricane damage in a given year. Then there'll be several years where everything's okay. Then there will be another year where there will be lots of claims. So notice that when the claims come is unpredictable, and also when the claims do come, they come in large amounts. That's why we say that these claims are both unpredictable and lumpy. There are two broad methods for distributing or selling insurance. One is direct writing, the other is agency writing. Direct writing is where the insurance company has its salaried staff, and that staff is taking care of selling insurance, or an insurance company might sell insurance through the internet. Agency writing is where an insurance company uses independent agents to write insurance contracts. As we might imagine, with direct writing, the fixed cost is relatively high because the insurance company needs to engage the staff to write these contracts, and the variable cost is relatively low. With agency writing, the fixed cost is relatively low, but the variable cost is high because every time an agent writes a contract, the agent gets a substantial commission. So the variable cost goes up. Let's now take a look at the earnings characteristics of property and casualty insurance companies. The macro view of this industry is that it is highly competitive, price sensitive, and cyclical. If we take the United States, for example, in 2015, there were about 1,200 property and casualty groups. So this is a very large number. Therefore, it is expected that the competition is high. High competition in the industry leads to low profitability. With low profitability, we have what's called a soft pricing market. In other words, there is pressure on the firms to cut prices in order to get more business. That leads to a soft pricing market. When prices come down, then some firms exit the market. So they just don't have enough capital to maintain the potential losses over here. So firms start exiting the market. When firms exit, the competition becomes lower and underwriting standards start becoming tighter. What this means is that insurance companies become more careful about the insurance contracts that they underwrite. The premiums start going up. With higher premiums, the profitability starts going back up. And here we can say that the pricing market is now hard. So from a soft pricing market, we now come to a hard pricing market. With higher premiums, firms enter. As more and more firms enter, the competition goes up, and then the same cycle repeats. So if we look at the profitability of the industry over a relatively long period of time, we'll notice that the profitability will go up and down. So that's why we say that this is a cyclical industry. Now let's take a micro view. The underwriting cycle is driven by expenses. When expenses are high relative to net premiums, then obviously firms will exit the market. On the other hand, when expenses are low relative to overall premiums, then firms will enter the market. The relevant ratio that compares the overall expenses of an insurance company with premiums is the combined ratio. This is the total insurance expenses divided by net premiums. When this ratio is low, then we have new entrants. So what does low mean? Low generally means less than 100%. So if this ratio is 100%, that means that total expenses are equal to net premiums. So this is a break-even scenario. If the ratio is 80%, that means that insurance expenses are 80% of net premiums, which is a positive sign. And if we have this sort of a combined ratio, then there will be new entrants in the market. Now let's get a little deeper into the expenses. For insurance companies, there are two major expense components. One is the underwriting expenses. This is the expense paid to employees. It's the commissions that are paid to agents and so on. It's essentially the expense associated with the overall underwriting process. And then the other component is underwriting losses. These are the actual claims paid plus the change in loss reserves. Now, this item, loss reserves, involves a lot of subjectivity. So, a firm will have to estimate what losses will be and then come up with those loss reserves. In a given period, if the loss reserves go up, then that adds to the underlying losses for a given period. From an analyst perspective, we need to evaluate whether a firm is doing a good job of estimating these loss reserves. If a firm is underestimating loss reserves, then that is an indicator of major problems in the future. Let's now look at some of the key ratios for the property and casualty industry. One ratio is the loss and loss adjustment expense ratio. So this takes one of the components that we just talked about, which is the loss expense. These are the actual claims paid, and the loss adjustment expense. This would be the change in loss reserve over a given period. We take that as the numerator and divide by net premiums earned. So this ratio tells us about the success in estimating the risks insured. If this ratio is high, that means that the insurance company has not done a very good job of estimating risks. On the other hand, if this ratio is relatively low, then the insurance company has done a good job of estimating the risks that it is insuring. Next, we come to the underwriting expense ratio. Here we take the underwriting expenses, so this is the cost of employees, the commissions paid to agents, and so on. We divide that by the net premiums written. This ratio is a measure of how efficiently the company spends money to obtain new premiums. Again, a low ratio is good and indicates greater efficiency. Then we have the combined ratio that we talked about. The combined ratio is the total expense, which is a combination of the losses as well as the underwriting expenses divided by the net premiums. But over here, we are showing the combined ratio as a combination of these two ratios. So that's why it's called the combined ratio, because it takes the loss and loss adjustment ratio and the underwriting expense ratio. So the sum of these two ratios is the combined ratio. It indicates the overall efficiency of an underwriting operation because it considers the total expense. Then we have dividends to policyholders or shareholders ratio. This is simply the dividends that are paid to policyholders or shareholders divided by net premiums earned. It's a measure of liquidity because it relates the cash outflow of dividends to the premiums that are earned in a given period. And then we have the combined ratio after dividends, which is the combination of these two. So this is a stricter measure than the combined ratio because we are considering how much money is being paid to policyholders or shareholders. This is a discretionary payment. So again, it measures the efficiency of money spent in obtaining new premiums, and it's a stricter measure than the combined ratio. Before moving on, I want to draw a distinction between net premiums earned and net premiums written. So notice with some of these ratios, we are concerned with what is earned. With others, we are concerned with written. The point here is that insurance contracts are written for a given period. The premium is typically collected up front when the contract is written, but the premium is earned over this period. So that is the distinction. At the start of the period, we can say that this is the amount of premiums that were written, but they are not earned in the beginning. The premiums are earned over this period. On this slide, we look at the ratios which have been calculated for 5 different property and casualty insurers. So let's take the loss and loss adjustment expense ratio. With respect to this ratio, the company that is doing the best is Markel Corp because the ratio is the lowest. So based on the numbers shown here, Markel has done the best job of pricing risk. Then we have the underwriting expense ratio. Here, the company that is doing the best is Travelers Companies. So this ratio is the lowest compared to the others, which means that the cost associated with the underwriting process is the lowest for travelers' companies. Then we have the combined ratio, which is the combination of these two. And with the combined ratio, Markel Corp is doing the best. Now, this number is 89%, which is well below 100%. Remember, 100% means that the total cost is equal to the net premiums. 89% means that the total cost is 89% of the net premiums. Hartford Financial Group is not doing well at all. Here, the total cost is 31% more than the net premiums. Then we look at the dividends to policyholders or shareholders. Here, the numbers vary from 3.1% to 11%. With Markel, the number is 0%, which means that no dividends were paid to policyholders. And then the combined ratio after dividends takes the combined ratio plus this number. As we've discussed before, this is a stricter version of the combined ratio because the discretionary dividend payments are also being combined. On this front, the best performer is Markel Corporation with 89%. Coming now to investment returns, as we've discussed before, insurance companies collect premiums and then this premium amount can be invested over a float period. So what we want to do is analyze the investments being made. With property and casualty companies, the investments should be steady return and low risk. The reason is that claims can come in at any point in time, and the insurance company should be able to quickly liquidate investments and cover the claims. So that's why we want relatively safe, low-risk investments which are highly liquid. When evaluating investments, the concentration of assets needs to be considered. So we need to know what sectors the investments are being made in. Most of the investments will tend to be fixed income investments. So we need to understand the concentration across different maturities, across different credit quality, industry sector, and so on. The investment performance can be measured based on the total investment income divided by investment assets. This exhibit shows the Travelers Company's portfolio composition in 2016 and 2015. In 2016, the total investments are 7488, and notice that almost 86% of these investments are in fixed income securities. The next highest contributor is short-term securities, which are almost 7%. A very low percentage of the investment is in equity or real estate. So this should not surprise us given that we want steady return, low risk investments. Next we come to liquidity, and we've already alluded to this. Given the nature of the property and casualty business, high liquidity is essential. The claims can come in at any point and the firm should be able to satisfy those claims. So from an analyst perspective, how do we evaluate liquidity? One way of doing this is by looking at the hierarchy of fair value reporting. Now, most of the investments are reported at fair value, but the question is whether those investments are level 1, level 2, or level 3. So what do these levels mean in terms of fair value reporting? Level 1 investments are those where the prices are readily available. These securities are traded in very liquid markets, so there is no ambiguity in terms of the price. We can simply get the prices of these securities from the market. Level 2 means that the security is traded in less liquid conditions and prices need to be inferred from similar securities in liquid markets. And with level 3, no pricing is explicitly available. The reported values are based on models and assumptions. So here, obviously, the liquidity is the lowest. When we do this analysis, we notice that most of the investments are in level 1 and level 2, primarily, in fact, in level 2. And there is only 0.3% in level 3. So level 3, where liquidity is very low, represents only 0.3% of the investments. If as an analyst we see a large percentage of investments over here in level 3, that would be a cause for concern. After evaluating liquidity, we come to capitalization. This indicates the level of equity capital that the company has. There are no global minimum capital requirements. However, different local jurisdictions can impose minimum requirements based on the risks being taken. From an analyst perspective, we should evaluate the sorts of risks an insurance company is taking and then determine whether the amount of capital is sufficient given those risks. We now turn to life and health insurance companies, and here again we will consider operations, earnings characteristics, investment returns, liquidity, and capitalization. So let's start with basic operations. With life and health companies, there are three major sources of revenue. One is premiums, then we have investment products and services. Life and health companies tend to sell several different products and services, and the fees and commissions collected from those services become part of revenue. And then, as with property and casualty companies, there is a significant amount of investment returns. Here again, premiums are collected when contracts are written, and there is a float period between the collection of the premium and when payments need to be made. So during that float period, funds can be invested. Life and health policies tend to be longer term compared to property and casualty policies. Also, life and health claims are more predictable compared to property and casualty claims. So for this reason, life and health companies can take on more risk and therefore get a higher return from their investments. There is a lot of variety in terms of life insurance products. This reading doesn't get into the details of all the different types of products, but in simple terms, we can have products such as term life insurance, where life insurance is offered for a given period. Now, if the insured party dies during this period, then the beneficiary receives a payment. If the insured party does not die during this period, then no payment is made. Insurance companies also offer whole life insurance, whereby the beneficiary receives a payment when the insured party dies. Insurance companies also sell various types of annuities. Health insurance products vary by type of coverage. Some products cover specific medical expenses and treatments. Other health insurance products make payments if the policyholder becomes injured or becomes incapable of working. Life and health insurance policies are sold directly via electronic media or through agents. Agents could be employees of the insurance firm. They could be exclusive agents or independent agents. As we've discussed before, with independent agents, the fixed cost is low, but variable cost is high because these independent agents need to be paid a substantial commission for every insurance policy that they underwrite. We now look at a very simple example related to revenue diversification. Here we have two insurance companies, Aegon NV and MetLife. We are given the revenue over several years and we are shown the major components of revenue. We have premium income, investment income, and then income from other products and services. So we are given these numbers and we need to compare the diversification across revenue sources, and then we should describe the trends in each company's diversification across revenue sources with specific reference to premium income. So we need to calculate some percentages here. In this exhibit, we see the various types of income in terms of percentage of overall income. Notice that as far as premium income is concerned for Aegon NV, the numbers have generally ranged between 65% and 70%, whereas for MetLife, the numbers have ranged between about 53% and almost 62%. So MetLife appears to have greater diversification across revenue sources because it generates about 62% here and then 21% and 17%, whereas with Aegon, a very small percentage is coming from other sources. So that's only 7.2%. So there is greater diversification with MetLife. However, we should keep in mind that the premium-based income tends to be more stable. So as far as stability is concerned, it appears that probably Aegon is better off because a larger percentage of revenue is coming from the most stable premium income. In terms of how the numbers have changed over the years, for both companies, the premium income is the highest level in 2016. So notice with MetLife, the premium income went up from 55% in 2012 up to 61.7%, whereas with Aegon, it's gone up from 65% to 69.7%. So the major trend seems to be that the percentage of revenue coming from premiums has gone up for both companies. The investment income has gone down substantially for MetLife over the last 2 years, and for Aegon, the investment income has gone down by 8.6% in 2016. Coming now to earnings characteristics, we've talked about revenue. In terms of expenses, the major expense components for life and health companies are shown here. So obviously benefit payments would be a major expense. Then, since life and health companies often offer annuity contracts, the annuity payments represent another expense. A third category is contract surrender expenses. The idea here is that insurance companies sell certain contracts which accumulate a cash value, and policyholders have the right to cancel these contracts. So if a policyholder cancels such a contract, the insurance company needs to make a payment equal to the accumulated cash value. So that is a cost for the insurance company. When evaluating life and health companies, we should recognize that several expense items require significant judgment and estimates. So, for example, if a life insurance company needs to make certain payments in the future, through actuarial assumptions, we have to determine what those future payments will be. Then a discount rate needs to be applied to come up with the present value of these future payments. So there is judgment with respect to the actuarial assumptions, there is judgment with respect to the discount rate, and so on. As an analyst, we need to figure out whether the assumptions being made are realistic or not. Also, earnings can be distorted because the accounting treatment across different items might vary. So, for example, assets might be recorded at market value, whereas liabilities might be recorded at historical cost. So the liabilities represent market rates at the time when the liability was created. What this means is that if market rates now change, so if interest rates come down, the impact on assets and liabilities will be different, and that distorts earnings. An analyst who is evaluating an insurance company needs to understand these possible distortions. There are several ratios that can be looked at when evaluating profitability. There are some standard ratios which apply across different industries. So return on assets, return on equity, the growth and volatility of capital, book value per share. So all these can be considered. An analyst can look at pre-tax and post-tax operating margins. But these last two items are specific to the insurance industry. An analyst can look at total benefits paid as a percentage of net premiums written as well as deposits. Analysts can also look at commissions and expenses incurred as a percentage of net premiums written and deposits. So in both these cases, lower ratios are good. So a low ratio implies that the benefits paid are relatively low compared to the premiums. And a low ratio over here would imply efficiency in terms of selling insurance contracts. Coming now to investment returns, liquidity, and capitalization. With respect to investment returns, life and health companies can take on more risk compared to property and casualty companies. And we've talked about this earlier. With life and health, The insurance period is longer, the payments are more predictable, therefore more risk can be taken, and since more risk can be taken, these companies can try and generate a higher return. When evaluating the investments made by life and health companies, we should look at diversification. So what is the asset allocation across different classes? We can look at investment performance by looking at the total return and divide that by the investable assets. We'll do an investment performance calculation in an example on the next slide. Interest rate risk is a major concern because many of the liabilities are relatively long term and they are impacted by changes in interest rates. Asset values are also impacted by changes in interest rates because a large percentage of these assets tend to be fixed income instruments. So we need to understand interest rate risk. The liquidity requirement is driven by liabilities. So if the liabilities are short term, then the insurance companies should have more liquid investments. On the other hand, if the liabilities are longer term, then the liquidity requirement becomes less. Sources of liquidity include operating cash flow as well as liquidity of investment assets. So if investments are made in short-term government bonds, those bonds can be sold very easily, and that represents a source of liquidity. The measurement of liquidity is fairly straightforward. Here we consider the amount of liquid assets relative to short-term liabilities. Obviously, the insurance company should have a sufficient amount of liquid assets in order to cover short-term liabilities. And finally, capital. Various jurisdictions have capital adequacy standards based on risk profile. So unlike Basel III, we don't have any global requirements related to capital. That is why individual jurisdictions come up with their requirements. Life and health companies generally need less of an equity cushion compared to property and casualty companies. The reason is that the benefit payments here tend to be more predictable and less volatile. Interest rate risk is a major factor in estimation of risk-based capital, and we've talked about that. The reason is there can be a maturity mismatch between assets and liabilities. This mismatch in maturity can become a problem when interest rates change. So an analyst needs to understand interest rate risk when evaluating the appropriate amount of risk-based capital for a particular insurance company. So we'll conclude this reading by doing example 8, which has to do with the analysis of an investment portfolio. So we are shown the investment portfolio for AIA Group. We are also given investment returns. We are told that of this number, 1471 million, approximately 127 million was related to debt securities. So of this number, this much was based on debt securities. Based on the information in this exhibit, describe AIA's investment allocation in 2016 and changes from the prior year. So if we look at the asset allocation, a large percentage is in debt securities. So we have 73.3% in 2015 and then the same percentage in 2016. Loans and deposits went down slightly, but equity securities went up slightly. But overall, the asset allocation hasn't changed much. So we can say that the asset allocation is more or less the same between 2015 and 2016. Next, we need to estimate the return on average fixed income assets. So we need to consider loans and deposits as debt securities. To come up with this number, we need the return and divide that by the average invested assets. So what is our return? Our return is the interest income, which is 5290 plus 127, because 127 of this number is coming from debt securities. And then we divide by average assets. So we take the sum of these two numbers, that's the amount at the end of the year. The sum of these two numbers is the amount at the beginning of the year. So add these two and divide by 2. That gives 116,265.5. And when we do this calculation, we get 4.7%. We finally come to the end of this very long reading. I will summarize the key points. The first key point has to do with the differences between financial institutions and other companies. Financial institutions have a very high systemic risk. So when we talk about financial institutions, particularly banks deal with all segments of the economy. They also interact with each other. If a major bank fails, that hurts the whole financial system and potentially the entire economy. Because of this high systemic risk, the level of regulation in the financial sector tends to be high. Second point has to do with key aspects of financial regulations. So there are three key aspects. One is capital adequacy. So financial regulation tries to ensure that banks have sufficient capital in order to withstand a crisis situation or a stress scenario. The second key point has to do with the availability of high quality liquid assets. And the third one, which is related to liquidity, has to do with stable sources of funding. So we want that even when a stress scenario happens, financial institutions have sufficient sources of stable funding. Then we come to analyzing banks. The approach that is discussed in detail is the Camel's approach. With the Camel's approach, we look at 6 components. The first is capital adequacy. So does the bank have sufficient capital to deal with stress scenarios? Then we have asset quality. So what is the quality of assets that the bank has? M stands for management quality. E is for earnings quality. So what is the quality of earnings? Are the earnings sustainable? Then we have liquidity. So what is the liquidity of the bank? What sort of liquid assets does the bank have? Are the sources of funding stable or not? And the final item, S, stands for sensitivity to market risk. So when market factors such as interest rates or currencies change, what is the impact on the bank? We also consider several other factors. These other factors can broadly be categorized into factors that are specific to the banking sector and then factors that apply to all companies. With respect to factors that are specific to the banking sector, we can look at the level of government support, how much government ownership is involved, what is the mission of the bank, and what is the corporate culture. With respect to factors that apply to any company, we can look at the competitive environment, the amount of off-balance sheet items, we can evaluate segment information, and the currency exposure of the bank. We then come to insurance companies. There are 2 types of insurance companies that we study in this reading. One is property and casualty. The other is life and health. We do not consider reinsurance companies in this particular reading. With property and casualty companies, the claims tend to be much more uncertain relative to claims from life and health companies. And because of that uncertainty, the liquidity requirement of property and casualty companies tends to be high compared to life and health. Also, the capital requirements tends to be high. When we talk about evaluating earnings, there are 2 major ratios that we need to be aware of. One ratio is the loss and loss allowance as a percentage of net premiums. This is a measure of how well a company evaluates and analyzes risk. If the ratio is low, that's a positive sign. A low ratio means that the payments made against claims and the loss adjustments, so this overall number is low relative to the net premium amount. The other ratio is underwriting expenses divided by net premium. So underwriting expense has to do with the money that is paid out as commissions, the money that is paid to employees. So this is basically the cost of writing insurance policies. Again, we want this ratio to be relatively low. The combination of these 2 ratios is called the combined ratio. If the combined ratio is 100%, that means that the total expense is equal to the net premium. So that's not a very positive sign. That basically says that a company is breaking even. On the other hand, if the ratio is lower than 100%, let's say it's 80%, that's a positive sign because that says that the overall cost is 80% of the premiums. With life and health, we have similar ratios. The subtle difference is that instead of saying loss and loss allowances, we basically say benefits paid. And in the denominator, we have the net premium plus deposits. So that's the ratio that's analogous to this one. Then we also have commissions and expenses, which is basically the underwriting expense divided by the net premiums plus deposits. So again, low ratios would be a positive sign for an insurance company. So that is it for this reading.